Hello, everyone. Thank you very much for joining us once again today. Welcome back. We are discussing today transactional net margin method of transfer pricing. So, till now, we have conducted 37 webinars on the corporate tax. And out of these 37 webinars, our last webinar was on the cost plus method of transfer pricing. I will discuss in the couple of webinars before that there are 5 methods of transfer pricing to establish the arm length price, and out of these 5 methods we discuss comparable uncontrolled price method of transfer pricing, resale price method of transfer pricing, cost plus method of transfer pricing, and this is the 4th one, which is the transactional net margin method of transfer pricing. As we discussed earlier, this is not the preferred method to establish the arm length price. This is an alternative method to establish the arm length price. Previous 3 that were discussed earlier, those were the preferred method to establish the arm length price. So this transactional net margin method, in a very simple way, I will say for each transaction, you will assess how much is the net margin. For each transaction, we need to assess how much is the net margin, and for each transaction, we need to identify how much is the net margin percentage against the basis. What is the net margin percentage against this specific transaction? The same should be for the arm length transaction. The same should be for the transaction with the related party. The same ratio should be for the transaction with the connected person. So just look into this. Basically, within the framework of transactional profit methods, approaches exist for ascertaining the arm length price, one of which is the transactional net margin method. So we ascertain the net profit percentage against any base. This base can be sales, this base can be cost, this base can be assets, depends upon the nature of the business, depending upon the nature of the business, size of the business, functions of the business. So objective is basically net profit divided by base. This base, as I mentioned, it can be cost, it can be sales, or it can be assets. These can be cost, sales, or assets. So basically, net profit divided by base, you will get NPI, which is called net profit indicator. So net profit indicator, whatever the net profit indicator for the uncontrolled transaction, there should be same net profit indicator for the controlled transaction as well. If the net profit indicator for the controlled transaction is same, and like the net profit indicator for the uncontrolled transaction, then we can say this is the arm length price. The transaction has been executed at the arm length at the par value. If the NPI of the controlled transaction is different from the NPI of the uncontrolled transaction, then there are chances of adjustment. And in case we are making any adjustment, and after the adjustment, the adjusted price of the controlled transaction, definitely it will be similar with the price of the uncontrolled transaction. So a couple of things are important. First of all, NPI, net profit indicator. Net profit indicator should be same for the controlled transaction. It should be same for the uncontrolled transaction. Second is the net profit. We need to calculate the net profit as well. We know how to calculate the net profit. It will be sales less cost of goods sold. In this, it will be direct cost, indirect cost. We need to ascertain the cost for each transaction wise. This is very important. So net profit indicator is equal to net profit divided by base into 100. As I mentioned earlier, I'm just repeating. The price of a controlled transaction, or the NPI of the controlled transaction, it should be same with the NPI of the uncontrolled transaction. If this is the case, then we can say the transaction has been executed at the arm length price. Variation in functions depends. Basically, functions are very important. We already discussed so many things, so many times, that functional analysis is very important. Based upon the functional analysis, each party will have the expenses, each party will have the assets. It all depends what type of function they are performing. If the more function the party is performing, more will be the asset, lesser function, lesser will be the assets. Expenses classification will be accordingly as well. So the functional analysis is very important. We need to look into this in detail. What are the functions that are being performed by each party to ascertain and to make the adjustment to make sure the price of a controlled transaction is equal to the price of an uncontrolled transaction. NPA of the controlled transaction is equal to NPA of the uncontrolled transactions. Just I wanted to give you an example. For the base, as I mentioned earlier, in case where the full cost or operating expenses can be filled in for the service or manufacturing. If a company is manufacturing, then the base will be full cost or operating expenses. If the company operating expense might be within a capital intensive industry, then manufacturing. It all depends between what are the functions of the company. Based upon this, we will ascertain the base. We need to do the functional analysis to ascertain the cost as well. Then we'll give the comparables. We know NPI. NPI is basically net profit, net margin divided by base. Base can be sales, it can be assets, or it can be cost. We know NPI. Oh, now we need to compare the NPI with the internal comparables or with the external comparables. Internal comparable means any group company or the same party if selling the goods or services to any independent party or third party, what is the NPI for the transaction with the third party? There should be same NPA for the control transaction as well. We have already discussed it so many times. It can be the same party, one party selling to related parties, a related party, and one party selling to third party. So whatever the NPA for this third party, there should be same NPA for this control transaction. This is called internal NPA. There is a possibility that two independent parties are dealing with each other. They have similar function, similar industry, similar size, same business. Everything is 100% same. Then we'll take the NPI for the transaction between two third parties, or so basically transaction between two third parties. That NPI is called the external comparables. So after, as I discussed, whenever we are calculating the NPA of the control transaction, there is a possibility that the NPA of the control transaction is equal to the NPA of the uncontrolled transaction. If the NPA of the control transaction is equal to NPA of the uncontrolled transaction, means there is no difference. Price is already at the arm length. Price is already at the par. If the NPA of the controlled transaction is different from the NPA of the uncontrolled transaction, and this uncontrolled transaction that we receive from the internal comparables or from the external comparables, if NPA of the controlled transaction is different from the NPA of the uncontrolled transaction, then we need to make the adjustment. And after making the adjustment, the price of a controlled transaction will be, the adjusted price of the controlled transaction will be equal to the price of uncontrolled transaction. Then we will assume that the transaction is at the arm length, at the fair value, at the par value. Steps required to apply the transactional net margin method. What are the steps that you need to follow to apply this method? First of all, calculate the net profit. We know how to calculate net profit: sales, cost, direct cost, indirect cost, allocation. This net profit is required, keep in mind, for transaction wise. Calculate the net profit, sales less direct cost less indirect cost for each transaction that you are assessing. Then identify the NPA of the control transaction. We know NPA is equal to net profit divided by basis. This base can be cost, it can be assets, it can be expenses. It can be sales as well. So identify the NPA of the uncontrolled transaction. Now you have NPA of the controlled transaction. You need to identify the uncontrolled transaction, comparable uncontrolled transaction. It can be internal or it can be external. So you need to identify the comparable uncontrolled transaction, and you need to assess the NPA of the comparable uncontrolled transaction. Then you need to compare the NPA of the controlled transaction with the NPA of the uncontrolled transaction, and you need to assess the price is same. If same, then no need of any adjustment. If the price is different, then you need to make any adjustment. So this is a simple technique how to proceed further and how to apply this method while assessing the arm length price in the transfer pricing method by applying transactional net margin method. It looks so simple, but the most challenging thing we are discussing again and again in our previous lectures: how will you identify comparable uncontrolled transaction. This is the most challenging thing. Rest everything is in your control. How will you identify a comparable uncontrolled transaction? Might be internal. If you have internal comparable, then this is very fine. It will be very easy for you to assess the internal comparable. If you don't have the internal comparable, then you need to go and identify the external comparable. How will you identify external comparable uncontrolled transaction? We'll discuss this in the challenges part of this presentation. Just look into this example. Skittles Limited, a UAE-based company, has sold 50,000 bags of sugar to its German subsidiary, Placers Limited, for dirham 600,000. Skittles Limited sold 110,000 bags of sugar to its French client for dirham 1.1 million. Keep in mind, this placer is a subsidiary related party. This is the French client, third party. 50,000 bags has been sold from the UAE entity to the related party, which is based in Germany. And at the same time, they have sold 110,000 bags to its client, which is the third party, independent party, which is based in France. The cost of production for each bag is 5, 2, and 2. It is the internal policy of the company that if the quantity of the order is more than 100,000 units, Skittles Limited offers a 1.5% discount. So you need to keep in mind that Skittles, whenever the Skittles is selling the goods to the French client, the quantity of the bag is more than 100,000. The quantity is 110,000. So we are applying transactional net margin method. We have already discussed, first of all, we need to identify net profit. Net profit, then we need to identify NPA. NPA of the controlled transaction, NPA of the uncontrolled transaction, comparison. If any adjustment is required, then we need to make the adjustment. So 50,000 bags has been sold to the Germans, 600,000. 600,000 divided by 60, the price will be 12. So 600,000 divided by 50,000, 12. 12 is sales price. Whenever the goods are being sold, when the sugar is being sold to the related party, the price is 12 dirham per bag. So production is 522. So 12 minus 9, 3. 3 is my net profit. Net profit, I'm assuming my base is sales. 3 divided by 12, 25%. NPI of the controlled transaction is 25%. How I identified? NPI of the controlled transaction is equal to net profit divided by sales. Net profit is equal to 12. How I calculated 12? 600,000 divided by 50,000 is equal to 12. 12 divided by 527 less 9 is equal to 3. 3 divided by 12 into 100. 25%. This 25% is the NPI of the controlled transaction, net profit indicator. The NPA of the controlled transaction is 25%. Now we need to assess the NPA of the uncontrolled transaction. Uncontrolled transaction, internal comparables are available. Once the internal comparables are available, then we need to ascertain the NPA of the uncontrolled transaction. NPA of the uncontrolled transaction is the same formula. Sales price is 1.1 million. Bags, how many bags has been sold? 110,000. 110,000. 1.1 million divided by 110,000. Price per bag for the French client is 10. Important thing is discount has been offered 1.5% for each bag if the customer is buying more than 100,000. So my price is 10. This is a discounted price, keep in mind. Plus 1.5, total is 11.5. 11.5 is my sales price for the comparable uncontrolled transaction. So 11.5 divided by 9 divided by 11.5 into 100. How much it will be? 11.5% minus 9, 2.5 divided by 11.5. So sorry, it is NP of the control. The net profit for the control transaction 10 divided by 1.5, it will be 11.5. So NP of the uncontrolled transaction is 11.5. NP of the controlled transaction is 25%. So NP already given basically. We have already calculated this is basically 10 less this. So 10 plus 11.1, 11.5. NPA of the uncontrolled transaction is 11.5. Controlled transaction is 25%. From the above example, we can calculate the net profit per bag for the controlled transaction is 3 and NPA is 25%. As we discussed, the NPA for the uncontrolled transaction is sales to friends at 10%. 10%, 1.5% the discount. This 10, as I discussed, this 10 is a discounted price. So 10 plus 1.5% total NPA is 11.5. This 11.5, what should be arm length price? We have two NPAs. The arm length price basically cost divided by, it should be the fair value NPA. So 10.169. So what should be the price for the 50,000 bags at the arm length price? So 50,000 bags price 10.169. So 50,000, it should be 10.1695. 50,000 multiplied 10.1695. 508,475. It should be the fair value. It should be the arm length price for the control transaction. But the compromise price is 600,000. Uncontrolled price for the 50,000 bags, keeping in view the same circumstances, keeping in view the term and condition, keeping in view the comparable uncontrolled transaction, the price would have been 508,475, but the actual price, compromise price is 600,000. And fair value margin is basically fair value profit is 58475. So what should be the adjustment? Adjustment value should be 91525. Basically, prior profit already booked, it should be 150,000. Actual profit 58475 based upon the fair market value price. What is the difference? This difference in 91525. Tax authorities will ask to make the adjustment in the profit. So if you are looking into this example, I am going to see how we apply this method. First of all, we have calculated NPA of the controlled transaction. Then we identified the comparable uncontrolled transaction. Then we have calculated the NPA of the uncomparable uncontrolled transaction. Then we have compared the NPA. After this, we have decided, we have checked, or either the price is same or not. The price was different because the price for the comparable uncontrolled price was different. Price for the controlled transaction, it was different. We need to make an adjustment. We have calculated the amount of adjustment as well. This is transactional net margin method. Factor needs to be considered. Important thing, as I said, this looks very simple to apply the method. You need to calculate the NPA, compare the NPA, make the adjustment, set the arm length price. But what are the factors that you need to consider? This is very important. First of all, you need to consider what is the treatment of operating expenses, non-operating expenses, same sector, same industry, same size, accounting classification. You need to look at the competitor as well. You need to look at discount as well. You need to working capital as well, business strategy. Might be you're setting up a business. Your strategy is just to penetrate into the market by keeping the prices very low. Might be you're selling it at the below the might be up to you're selling at cost to cost basis. You're not making any profit for the time being. Your selling strategy, it all depends. You need to consider all these factors to ascertain, to keep yourself in the same environment, similar situations where the size is same, situation is same, circumstances are same, functions are same risk has been taken, same asset has been deployed. After considering all these factors, then you will be able to assess, is this a comparable uncontrolled transactions or not? As I discussed in a previous lecture, if you are taking data of millions of companies, might be you will be able to find comparable 10, 25, 5 comparable transactions, comparable companies. This is a situation like this, because a lot of companies will be eliminated into the different sector. Company will be eliminated different functions, different price, different strategy, different offices, different employees. There's so many other factors as well. So you need to consider all these factors while ascertaining the comparable, while calculating the, while ascertaining, while finding the comparable uncontrolled transactions. Functional analysis is very important. This example I have taken from the guide which has been published by the Federal Tax Authority. A subsidiary, be the US distributor of coffee machines. Company B is a distributor of coffee machines. All companies, these coffee machines are produced when overseas related party, parent company. Parent company is outside. Parent company is outside. B is inside. B is the distributor. Here is the parent company. Here is the B. This is the parent company. This is B. B is the distributor for the coffee machines. Household electrical appliances brand name. All of the companies B, the merchandise purchased from its parent company B, yes, hold limited amounts of buffer and inventory, and the associated holding costs are determined to be immaterial. Parent company provides a product warranty to customers of company B. Warranty, manufacturer warranty directly to the customer for the parent company. After performing the appropriate functional analysis is a very, very, very important thing while ascertaining the comparable uncontrolled transaction. Company B was able to identify a series of UAE distributors of home electrical appliances as suitable comparable companies. However, following a review of the financial information of the potential comparable companies, it is evident that number of them record higher level of inventory holding warehousing expenses. While companies B's inventory holding costs constitute less than 1% of its operating expenses. Company B, which is a distributor, the holding cost, because they are keeping very less inventory, the holding cost is less than 1% of its operating expenses. Reliable market evidence indicates that the independent distributors of the household electrical appliances in the UAE inventory holding costs at an average of 15%, the hell of difference. One company, 1% holding cost, competitors, same sector, same industry, 15% operating expenses. However, the holding cost an average of 15% of operating expenses. However, the available financial information of potential comparable companies is not detailed enough. Information is not available to ascertain the classification of the inventory holding cost. As such, you cannot bifurcate the basically holding cost. One company less than 1% of the total operating expenses, other 15%, around 15% of the operating expenses. Information is not available. You cannot ascertain what is the breakup of this 15%. Information is not sufficient. As such, it is more reliable to examine the net profit margin in this case. You cannot ascertain the net profit margin. As such, it may be more reliable to ascertain net profit margin in this case. Considering the relevant factors above, it to determine the transactional net margin method based upon the return on sales. Basically, transactional net margin method consider total expenses, might be direct expenses, might be indirect expenses. Whenever you are considering total expenses, so if the more information is not available, you can take the total expenses of the companies in the market, you can take your own total expenses, you can make comparison at the total level, at the entity level as well, if the sufficient information is not available for the transaction wise. So they are asking sufficient information is not available, you can go and apply transactional net margin method, which is the most appropriate method to apply in this case. The potential comparable earned company operating profit 10%, analysis of B, company B revenue is 5,000, cost is 4,500, operating expenses of 400, total cost is 4,500, total operating profit is 100, NPI is 2%. So in the same way, you will be able to assess the NPI from the market. The potential comparables operating profit margin is 10%, your is 2%, then you can make the adjustment. After making the adjustment, you will be able to ascertain the price, which should be the arm's length price. Where net profit is way to sales, a question arises, the rebates, discount. It all depends upon the company policies. Some companies are debating rebates, discount as a part of the sales. Some are deducting from the sale directly and GP will come down. Some companies basically considering as a part of the operating expenses. In the same way, it all depends upon the accounting classification. Whenever we are going for a comparison, we need to make apple-to-apple comparison, like-to-like comparison. So that will be quite helpful to apply this. We need to look at accounting principles while ascertaining the net profits. Classification of cost is very important as well. How the cost has been classified might be, they are asking, as I mentioned, might be part of the GP, might be not part of the GP, part of the operating expenses, might be it will hit the GP, might be it will not hit the GP. So classification of the operating expenses is also very important to ascertain the comparable uncontrolled transaction prices. Another word called Berry ratio, this is another tool to ascertain the arm's length price. Berry ratio, this is similar like transactional net margin method, but it considers the operating profit divided by operating cost percentage. Then the same principle will be applicable for the Berry ratio, operating profit divided by operating cost. Instead of net profit divided by sales, transactional net margin method, NPI for the transactional net margin method, they are applying Berry ratio, operating profit divided by operating cost. then they will go the same principle, same scenario, comparable, internal comparable, external comparables. If the barrier ratio for the entity should be same for the comparable controlled transaction, this comparable controlled uncontrolled, sorry, for the comparable uncontrolled transaction, this comparable uncontrolled transaction can be internal or external. This is another method to ascertain the arm length price. Transactional net margin method you can apply at the individual transactional level. This is highly recommended to apply at the individual transaction level. But if you cannot apply at the individual transactional level or the transaction level, then you need to apply at the overall company level. The law says basically if you are applying it on the overall company level, then you need to make sure that the company is a similar sales functions, everything is similar, then it will give you a good result. The operations are integrated. If the operations are integrated, then it will give more reliable. Otherwise, if the operations are not integrated, then this method will not give you reliable, it will not be a reliable price for the to ascertain the arm length price. But this is highly recommended. You need to apply this method at the transactional level instead of the entity at the overall entity level. Strength of this method are basically expenses classification. It doesn't matter either you are classifying direct expenses, indirect expenses. At the end, we need to take the net profit. So expenses classification, it doesn't matter how you are classifying the expenses. In the same way, examining the financial indicator, only one of the associated enterprise. One enterprise comparable uncontrolled transaction is sufficient to ascertain, to check either your price is comparable, either your price is arm length or non-arm length. What are the weaknesses of this method? Basically, the weaknesses are theme that we keep discussing for other methods as well. How will you ascertain? How will you calculate NPA of the external comparable uncontrolled transaction? How will you ascertain? How will you ascertain the arm length price? How will you get the information? How will you make the adjustment after getting all this information? This is one of the most bottleneck while applying the transfer pricing method. Conclusion, simple, calculate the NPA of the controlled transaction, calculate the NPA, identify the comparable uncontrolled transaction through internal comparable, external comparable, then calculate the NPA of the uncontrolled transaction, compare the NPA of the uncontrolled transaction with the NPA of the controlled transaction. If this is same, it means your price at arm length. If this is not same, you need to make an adjustment. While ascertaining the base, we need to do the functional analysis. We need to do the classification of expenses. If this is the case, then we need to classification of expenses, external comparables, internal comparables, functions we have performed, risk taken, assets utilized, functions performed. We need to do the function analysis, and the functions are different risk has been taken, different assets have been deployed. Then we need to make the adjustment as well to ascertain the arm length price. How can we help? We are happy to help you for the impact assessment, implementation, compliance, and advisory services. You can contact me. You can contact Faiza, she's our tax director. You can contact Shahid, he's our assurance and tax director. You can contact the rest of the team members as well. We are always happy to help you. We are always ready to listen, ready to understand, and ready to deliver. You can approach us at info@kresscooper.com, or you can give us a call 971-3391488. You can drop us an email at info@kresscooper.com. Thank you very much for being with me. If you have any question, you are most welcome. Okay, fine. Thank you very much and have a lovely evening. Nice. Thank you very much. Nice speaking to you. Thank you. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.